Thank you for joining me this morning, and thank you to our panelists too. Welcome to the State of Business Brokerage, a webinar we're going to talk about opportunities for buying and selling a business in 2021. I'm Joel Schattler. I'm the editor of Finance and Commerce, and I'll be your moderator today. Before we get to our panelists and dive into our discussion, just a few things about the format. First, if you miss any of this or want to listen to it again or view it again, we are recording it. We'll have the video available, but we'll also have the audio available on our podcast. And if you're unfamiliar with our podcast, it's called Beyond the Skyline, and you can find it wherever you listen to your podcasts. So that said, I'm looking forward to our conversation. The format will be, we're going to hear from each of our panelists first to talk about their unique perspective on buying and selling a business. They're going to talk about it from their area of expertise, talk about the market, talk about what you need to know for that. After each presentation then, I'll have some follow-up questions for each of them, and we'll start an organic conversation. But this is interactive, and I want to hear from you, the audience members, and we'll try to take as many of your questions as well. So just use the Q&A function or the chat function, and I'll be monitoring those, and I'll be taking your questions. So that said, let's begin. Our panelists, I'll introduce quickly our panelists, but we'll be hearing from them one by one. But our panelists today are young Bebus. She's the president of VR Business Brokers. Don Kaiser is a managing principal at Hannover. John Thwing, the SBA guy at 21st Century Bank. Lisa Holter Ankel, an attorney at Avisen Legal. And Brian Larson, senior vice president and a financial advisor at Morgan Stanley. So thank you all once again, panelists, for joining me today, and thank you again, attendees, and let's just dive right in. So first, we will hear from young Bebus, president of VR Business Brokers. If you want to start and tell us a little bit about your perspective and what you do, and also about what you see as opportunities for buying and selling a business.
Sure. Thank you, Joel. Good morning, and thank you for the introduction, and great to be here this morning. Hope you're all enjoying the nice, warm sort of weather here in Minnesota. As a business broker advisor and business certified appraiser by International Society of Business Appraisers, what we do is here at VR is we work with the business owners providing a full range business brokerage services for privately held companies. And this include 100% transaction brokerage services to mergers and acquisitions, divesting activities, and to a formal business appraisal services. And prior to opening a brokerage office, I was in a healthcare assisted living operations as a regional director and COO. And so many of the business practice within our office here at VR sort of carries through the discipline and quality services that we strive for. And we become valued representatives for our clients, and we provide valuable resources and with disciplined, very active responsiveness. I'll briefly touch on what we see in the marketplace from the brokerage standpoint. This information probably have been circulated over the course of many years. We talk about baby boomers aging and retiring. So what we see for seller perspective, we see a lot of baby boomers, business owners are retiring in record numbers. With baby boomers owning 2.34 million small businesses in the United States and employing more than 25 million people, they are retiring, and they're thinking about retiring and planning to retiring. So more businesses to come onto the market, this means, because there are internal transactions and external transactions, and the many nowadays do choose to market to external buyers for various reasons. For buyer perspectives, we work with a lot of corporate executives sort of coming out of the corporate and starting their own business, wanting to purchase existing business through an acquisition activity, or some of them form a private equity groups because they have been in the space, they're experienced, so forming private equity groups, partnering with financing institution, or a corporate seeking consolidation for various reasons, private equity group with a strong committed funds that require portfolio platform or add-on, they're still very active in the marketplace. As far as quick trend information is that based on Deal Stats Value Index published in the Q1 of 2021, our median selling price over EBITDA, which we use a lot for the valuation for the company, for Q1 was 4.3 average, Q2 was 3.7, Q3 was 4.7, went up significantly, Q4 is 4.4. So considering the pandemic we had, the valuation is still pretty historically strong. But although the information I just provided includes private market of all sizes, all industry sectors, so please be aware these are different. But those are just the overall trend we see in the marketplace. And Don?
Thank you. Good morning. My name is Don Kaiser. I'm the managing principal of Hannover Consulting. We provide business finance consulting services, primarily to small to middle-sized businesses. Young and I work together with partners on M&A transactions. So, for example, we're doing one transaction now, a local company that is in about the $8-9 million range that we are helping sell. And it's the likely buyer now, we're in negotiations, is a Western state private equity group, which is using a combination of bank debt and committed equity capital. From my perspective, the current economic situation in the U.S., partly due to the pandemic, has created a number of opportunities for both sellers and buyers. Some firms are proving the viability of their business model, and by continuing to grow, to maintain viability, to adapt, and to meet their customer needs. But other firms are struggling to adapt to the changing economic situations, and are choosing in many cases simply to sell. It's a very difficult time for a lot of businesses, and they're not surviving comfortably. Other firms are choosing to sell, as Young pointed out, for the traditional reasons of age retirement and health issues. So what we're seeing is a tremendous number of opportunities for buyers who want to grow by adding on other companies, and sellers who need to exit. So we're seeing a significant increase this year and last year in company sales and purchases. And on top of that, there is a great deal of capital available to assist in these acquisitions, both debt and equity. As business brokers, we can assist our clients in analyzing their needs for selling or for buying, structuring the transaction, doing the valuation, then entering the market in the most efficient manner possible, both in terms of cost and in terms of time. Thank you.
All right. Thank you both for that. I'm sure there'll be a lot of follow-up questions for each of you too. So I appreciate that summary. Now, John Thwing, do you want to give your presentation?
You bet. Hey, everybody. Good morning. Don, great segue. Thanks for talking about capital. My nickname is the SBA guy. It's what I do. It's who I am. It's my license plate. The thing I like folks to know is there's lots of forms of capital out there. Banks and SBA lenders like myself provide one of the forms of capital, primarily debt. There is certainly equity in the market, but debt is one of the funding mechanisms that folks like to use. And as Young mentioned, for me as well, I see a lot of what I refer to as corporate refugees, folks who've had good, successful careers. They've built net worth and liquidity. They're kind of tired of working for a large organization and would like to strike out on their own. And right behind the baby boomers, and honestly, even some baby boomers like me that still want to be owners, the age of folks I've seen in the market, I've got folks in their 60s still buying businesses. Right. So to me, it's really key that for a lot of folks, it's just in their blood. They want to own. So part of what I see in the marketplace is it's a very active and healthy market. A lot of people are curious today, how has the pandemic impacted the market and lenders' appetites? We're still in a very healthy lending environment. And honestly, we're still in a seller angled or leaning environment. With most of my clients, they have to chase businesses for a while. They have to make offers quickly, and they have to make strong offers on attractive businesses because there are more qualified buyers than there are good sellers. I want folks to know that financing for a business acquisition to fund a going concern is a specialized little area. And not every lender is really well associated with that or has a lot of experience. So As you're talking with lenders, make sure you have someone that understands this and they've done going concern financing. They understand how to finance goodwill and they understand all the choices available. Choice is important. And the reality is some buyers have more choices than others, but regardless of how many choices you have, you should understand all of them and have someone who can help you pick the best path. One of the things I like to say is fundamentals first, funding tools second. So your lender should also be familiar with how to analyze cash flow, what kind of valuation metrics are normal in the market and in the finance world, and really look at the fundamentals of the transaction first, know if there's viability and is it an attractive opportunity for the buyer, then talk about the funding mechanism that best fits the person in the situation. Some of the tools that we use are the SBA 7A program. We also use the SBA 504 program when there's real estate involved. And for some borrowers, bank financing is available as well. And then there are folks who have additional alternatives personally, where they're going to fund or leverage some of their personal assets. They may have significant equity in their home. They may have liquid investments that they can leverage. Those are funding options for folks as well. My advice is, in this historically low rate environment, find a lender that you like. If you're interested in owning, be active in the market, look at transactions, get to know your lender, and be out there and be looking. Couple things to know in terms of the kind of what I call hot topics. There are SBA incentives in the market. So if SBA ends up being your funding tool, typically transactions of around 5 million and less. There are incentives in the market today related to the stimulus package for SBA transactions closed and funded prior to September 30th. So that's certainly increasing urgency. And the this low rate environment, we actually think it'll stick around for a while, but there has been a little movement lately. So a lot of folks are moving with urgency today. So if you're interested in looking, we're here to help you look.
Thank you so much for that, John. Appreciate it. I'm sure there's going to be a lot of follow-up questions too around lending and such too. So a reminder too to get your questions out there too, and we'll look for those. So thank you. So Lisa, perhaps you can talk about this market, talk about buying and selling companies from your perspective.
Thank you. I'm a lawyer in our Avisen. We build a boutique business model. Lawyers like you spent 20 plus years at law firms.
We're having trouble hearing you just for a
Lisa,
second.
your microphone is not working properly.
I think we're having just a little trouble. You want to try and start again? I'm sorry. Oh, no. No. Okay. Try it one more time. Can we hear you, Lisa?
Or log back in again?
All right. Move on. And I will try that again.
Okay, we'll catch up to you, Lisa. We definitely want to hear from you. That happens.
Don't log back in again.
You can log back in again. So as you're doing that, we'll move on to Brian. Brian Larson, if you want to talk about, from your perspective of money, talk a little bit about this market and from what you see.
Yeah. Thank you, Joel, and good morning, everyone. Unfortunate to hear Lisa. I'm also excited to hear what she has to say. Again, as Joel said, my name is Brian Larson. I founded the Fernhill Group at Morgan Stanley, a 4-person professional team that manages $300 million for a select group of business owners and their families. I have over 30 years of experience in investments and wealth management. I have the Chartered Financial Analyst designation. The CFA designation is considered one of the most challenging designations in finance to accomplish. And lastly, our team has the resources of Morgan Stanley behind us, one of the best wealth management firms in the United States. So I guess I'm here to really talk about a liquidation event. You are maybe a serial entrepreneur, or you might be selling your life's work and you are working closely with Don or Young to market your business. Early on in that process, I want to meet you because some of the things on your personal life are going to be hand in glove with what you're doing with Young and Don. Specifically in the wealth management process, we talk about financial planning, and this is going to be something early on in the process of selling your business that you're going to want to be a part of. What is financial planning? Well, you have the quantitative part of your life, your assets, your liabilities, your investments, your risk tolerance, and we need to marry those with your goals, the qualitative things. I'd like to have a condo with an amazing pool in Bonita Springs, Florida. I want to have a house on a golf course in Scottsdale. I want to make sure my grandchildren graduate from college without debt. So a financial plan marries those very quantitative items of your life with the qualitative parts of your life. And you need a talented team, I think, to pull out some of those goals that you haven't really thought of because you've been running your business for 20 years, right? So financial planning is a big part of this process, and it starts early because Don or Young are going to say something to the effect of, hey, we're selling your business for $10 million, but after taxes and fees, you're only going to get $7 million. And by the way, they might be telling you that early on, but until we sit down with a financial plan and lay that out, you're like, oh, I'm only going to get $7 million when we're all done with this. So that's a big part of it. But there's other parts of the wealth management process that are really integral as well that you want to start bringing up early. Things like risk management. Do you have enough life insurance to back your overall balance sheet? Retirement planning. Often the affluent business owners forget that a claiming strategy for Social Security can actually really optimize your retirement. Tax planning. We work really closely with your tax advisor to make sure we're doing everything we can to minimize your tax situation and take advantage of things. Investment management. Most people, when they think of Brian Larson and our team, realistically, we think about investment management, and that is absolutely a part of what we do. But there's so much outside of that with wealth management. Liability management. I think so much about the asset side of our lives, but that leverage, that liability side is also equally important. Legacy planning. You just sold your business or in the process of selling your business. Perhaps it's going to be a big part of your life. How do you get the wealth that you created to the next generation in the most efficient manner? Philanthropic guidance. Boy, this is one. It's so integral, especially if you're in the middle of a liquidation event. And if you are charitable already, then we can marry a lot of what you want to do with this liquidation event. And then lastly, trust services. All these moving parts, and some of them you're going to want to give to a trust department, the liability, the management, the responsibility to a trust department. So wealth management is a wide variety of things. Lastly, I want to talk about fiduciary duty. When you're working with somebody in wealth management, fiduciary duty is the highest standard of care. It means that this individual has your best interest at heart before themselves or their company. And I would guide you to always take a look at making sure that you're working with a fiduciary in that standpoint. If you want to get a hold of me, you can find my details at thefernhillgroup.com. Thank you, Joel. I'll turn it back over to you, sir.
All right. Thank you so much for that, Brian. Appreciate it. We've got Lisa back. So let's hear next from Lisa. Let's give us your perspective. Thank you.
All right. Now,
Great.
How's my audio?
Perfect.
Perfect. Thank you.
Okay. Well, good morning. Thanks for being here. Glad I could finally join in. I'm an attorney at Avisen Legal, and I've practiced for more than 25 years. My partners and I at Avisen, many like me, have more than 20 years practicing at big law firms. And I decided a couple years ago that I'd like to do things a little differently and be a little more entrepreneurial. And so I have 10 colleagues, and we own our firm and make all our decisions a lot like our clients, and find that our clients enjoy this, working with us directly. Senior attorney, years of sophisticated legal work under our belts. As a business attorney, I work primarily with private companies, closely held businesses, family owned, also some that are owned by private equity groups. But I work with companies through the life cycle of their business. So if you think about key events in the life of a business, that's where I tend to get involved in forming the business, key contracts, vendor relationships, sales of products, bringing employees on, and then growing your business through acquisition or selling your business as well. Those are the key events. So over the years, I've represented many owners and founders of businesses when they sell. I help my clients in a couple ways in the acquisition area in particular. I'd say three key things. One, I get involved early on to help talk about the structure from a tax perspective to do it most effectively, stock versus asset analysis. And we do that early on because it impacts the purchase price and the net proceeds to the seller. I also help my clients in the due diligence process. I have lots of easy organizational tips to help organize due diligence, like online data rooms. But more than that, I think from a seller's perspective, we want due diligence to be presented in a way that shows the business in the best light. And from a buyer's perspective, you're looking for unknown liabilities, and you're sort of discovering things and digging. And I've done it hundreds of times, so I really know what to look for. And finally, I document the deal, as most people would expect. But more than that, I help my clients get the best deal terms because I've done it so many times. I really know where to push back or ask for more, so to speak. So there are a couple things I wanted to share about deals now and what's going on, and some highlights about the legal process. There are a couple points where you want to engage an attorney early on for tasks that will take a handful of hours, cost very little, but potentially save you thousands of dollars. Have an attorney review your engagement letter with your broker or investment banker. For example, many are going to contain a tail provision. Sorry, Don and Young, but you're going to want to understand what that is because there could be liability that ends after the engagement ends, and you'll want that time period to be as short as possible. You'll also want an attorney to review a letter of intent. Key issues will be the structure of the deal, like I mentioned, from a tax perspective, stock sale versus asset sale, but there can be other things as well. I just looked at an LOI for a client, small deal, so he really didn't think it was going to be, much to deal with, but the LOI was binding on the seller and had a very long lockup period. But for the buyer, there were due diligence and financing out. So having the document be binding on one party but not the other really impacts the negotiating leverage once the deal moves on. So those are areas where I'd say get your lawyer involved early. It's really important, I think, for clients to understand the difference between stock and asset deals, and I can't go into that in huge detail here. But basically, a stock sale is where the owner of the business is selling the stock of the business. The business stays the same, the ownership changes, versus an asset deal where the business is selling its assets. The company remains in place after the sale, but without operating assets. The buyer owns those assets, so the business is changing. It's now run by a new entity. That could be more disruptive for customers, employees, vendors, things like that. But generally, a buyer prefers an asset deal, because the buyer will get a step up in basis on the tax value and obtain tax deductions for depreciation and amortization, versus the tension with the seller preferring typically a stock deal with one level of tax at capital gains rates. So it's important to deal with those things early on in your LOI. Some things that I'm seeing now in deals, a lot of discussion about Ppp loans has come up, and I've really seen the gamut of how that's been dealt with, that many businesses, the buyers will not close the deal until the PPP loan has been forgiven. In the middle is an approach where there's some security or collateral, perhaps the full amount of the PPP loan is put in escrow until it's repaid, but then, or forgiven, and then the escrow would be released to the sellers. In other cases, the buyer's been willing to assume the loan and the risk with some indemnification for it, but close even with it outstanding and without dollars being held in escrow. So I've seen quite a range of that. Some other things to think about, I think in general, it's a seller's market. I've heard that from a number of people. And I think Don and Young will speak a little bit more to that even. But deals might be taking a bit longer because of this change in the operations of the business during the last year, and buyers wanting to really understand how any changes, up or down in profitability are going to impact the company long term. As well, because of COVID and issues relating to distancing, travel, things like that, I'm seeing fewer on-site meetings, taking longer to schedule those meetings, things like that have lengthened the deal process a little bit. One other thing I want to add in closing is this goes regardless, but I think it's really important for sellers to have realistic expectations about how time-consuming the due diligence process is. Responding to due diligence requests and pulling all that information together takes up a significant amount of time. This is evenings and weekends. Don't plan vacation. You have to be able to do this and run your business, because it's going to be critical to hit your budgeted earning levels during this time frame. Otherwise, you could have a buyer seeking to reduce the purchase price. It's typically more than one person can do, so you should get your deal team together early on, both external and internal, but look at the key functions of the business, what's critical, and key people who can handle that and be discreet, and consider even retention bonuses for these employees in order to have a successful close to keep them through the closing time frame. So those are my thoughts as we start out here. Thanks.
Great. Thank you so much for that, Lisa. That was a good description. There are follow-up questions for each of you individually. A reminder to keep your questions coming too. I'll watch for those. Thank you for those who've already submitted some questions. So great. Let's just start with our conversation generally with that big picture view, and building on some things that Lisa said, and also Young and Don and even John, but just talking about that market right now in general. You're describing it as a seller's market. What is the market like for today from both a buyer and a seller's perspective, with the economy the way it is, to also just looking a little bit more in detail on the demographics? Who is the buyer out there? Who is selling? Does anybody want to start specifically on? Yes, Don.
I'm happy to start off there.
Great.
Part of what's driving the market is the demographics. The baby boom is now reaching its 60s and 70s. They've had a long run. They've had a successful run, and now they're saying, it's time to hang up the spurs. I mean, the guy that we're dealing with now, Young and I, is in his early 70s. He's had a wonderful career, made a lot of money, but it's time to retire and play golf in Arizona. So that's part of what's driving it. Another part is the pandemic. It has really stressed a lot of businesses. For example, if you look at the restaurant industry, the hotel industry, and the retail industry, they're being hammered by the recession, by the pandemic. And they're just saying it's time to get out. We're having too much trouble. So that's part of what's driving the seller's market. From the buyer's market, A, there's a lot of capital out there. B, there's a lot of people who want to own their own business. They're retired execs, or they're execs who got laid off, or they got bored working for corporate America, and they want to own their own business. It's a challenge to that. That's part of the dynamics from my perspective, and I'm sure Young can add a lot to that.
Right. So when we look at the business owners, it could involve the different circumstances in life. That could involve retirement, as we talk quite a bit about it right now with the baby boomers retiring. But the same question comes up whether they're reaching retirement or not. My business is doing great. Why do I sell? Or my business is struggling. I need to sell. For the question of my business is doing great, I'm making a lot of cash flow than I have ever before. So if I sell, there might be some tax liabilities, capital gains tax. What do I do with those? And really, I have people running the business for me. Why should I sell? But the owner, a lot of times, kind of answer to themselves where the conclusion that they arrive is, I could have a good succession plan internally within company who can run my business. However, what happens if something happens to me tomorrow? I owe this to my family to have exit plan in place so that I can choose the right path to transition for my family, whether they're in the business with me or not, unless there's internal buyer to it. So I owe this to my family to have a plan in place. So I'm going to go and do transaction now where my business is doing well. Or I have had business owners who decide to sell because they're so tired from running business. They need some vacation. So it depends on how their business and organizational structure is made up. Their decision-making process becomes quite different. Some might be a little bit shorter time parameter and say, I want to sell fairly quickly, or I have a plan in place. I'm going to take about 2 to 3 years and really kind of look at what my value is today, and then plan in advance 2 to 3 years to make sure that I hit my business benchmarks to make sure that my business is attractive. Because it could be the same business with the same EBITDA, but business attractiveness could be different based on revenue mix, customer mix, contracts in place, and all those different variables that comes with the business. And I have other business owners who have handsome young growth growing path where they will say, I kind of want to see what it looks like in my sector. What are buyers looking for? Because I want to grow my business attractively and I got all these great ideas, but I need to narrow it down, have a strategy. So that's more of a corporate strategy where they're talking about, okay, let's talk about, who are looking for, what are they looking for, what's important. Granted, business is not always formed to really sell. Obviously, it needs to grow. And there are various different reasons, but it's good to have as part of the business plan, what are the exit plans? And those are important perspectives to have for the owners to be able to grow business in the ways that really brings a maximum value at the time of exit. Because, what the wise man said, nothing lasts forever. And what business in itself is too, the people in itself is too the same. So we need to plan ahead. That's a part of a lot of business owners are doing that. And as far as buyer-wise, I think it was very well said by Don. There are a lot of people coming out of corporate or corporate executives, and a lot of consolidation going on right now, lots and lots of consolidation. Now, granted, I don't want people to mistake and say, because this is seller's market, we can sell it for whatever price. Like Lisa said, right expectation and managing the expectations is an important part of the transaction too. If I say my sector goes for a EBITDA of about 3.5 times of multipliers, where if I say, well, I really need to get 5 times multipliers for me to be able to successfully retire because of, current financing that I carry, and or my exit plan for healthcare retirement or whatever have you, it's the two different things where there's an expectation and what I want to get versus what the market is going for. So it's important to know what the differences are so that you can plan again the corporate strategy as well as, or kind of timing that exit strategy really is important. We have a client we work with for, say they send us some information and say, take a look at them. How does it look this year? So those are good strategies to be working with advisors.
I did say it's a seller's market, and one characterization of it that I've heard again and again right now is that there's sort of companies fall into three buckets. Those companies that experienced a downturn and a dip through the summer, and maybe again towards the end of the year with closures, but came back after things reopened in the summer, and came back at a fairly good run rate and are stable. Another group that were just devastated. Some just have closed and they're gone, but they've been profoundly impacted and they have not recovered at all. And then finally, there are some companies that have done very well because of COVID. And so if your business is one that has not been, that has been extremely impacted and is not doing well, it is not the time to sell unless you, there are sellers who just want to get out, but you're going to really feel the impact of it in the valuation that you'll get, despite the fact that it's a seller's market. For the other businesses, it's a great time to sell, and there are, some buyers who have gotten through this and their company's stable and think it's a great time to get out. Unlike the recession in 2008, 2009, I've heard capital is still very strong, and John can speak to this, but lending is still very strong. So that's, I think, buyers have cash. There's a lot of money on the sidelines, and that's what's keeping valuations up and valuations strong. Although I have heard that for those companies that have done really well, buyers are not sure how to price them. And the deals that we're seeing get done quickly are ones where the companies know that it was a blip and they're not trying to incorporate the increase in revenues during, second, third, fourth quarters into their run rate and multiples fully. But if you think it's going to continue, you might have a harder time getting the buyer to agree to that, because the buyer won't have had a history, and everyone is still uncertain about, what is their new normal.
Thank you for that. John, I wonder if you have some comments on the market as it is now. You did comment it on your opening remarks, but I wondered if in our conversation, if you had anything extra to add.
You bet.
Okay.
And I want to touch on a topic we haven't really talked about yet. And so you'll notice that with deal professionals, like a lot of us, we spend a lot of time talking about numbers. I want to talk a little bit about feelings. Right. So let's all talk about our feelings. So what I'm getting at there is, on the buy side, of course, I'm mostly aligned with buyers and their experience, both financially and emotionally. Sellers are having a different set of emotions, but on the buy side, people tend to focus on financial preparation. And somebody like me can help you do that on the buy side, help you make sure that personally you're prepared, help you think through things, and Lisa can help assist with this. What's the proper ownership structure? Will your spouse be included? But most of my buyers are people rather than entities. They are going to form an entity. Most of my clients are either individuals or a group of investors, a relatively small group, 3, 4, 5 people. And almost all of them are going to be providing a personal guarantee. That's when the bank puts its cold, clammy hands on you, kind of like at the doctor's office. So it's an emotional issue that people need to understand. And I would say for buyers, a key part of this is being emotionally prepared. The corporate refugees who move from a W-2 career, where the risk is losing their job and their earning stream, once you own a small business, and particularly one where you've personally guaranteed debt, it's a significantly different risk profile. Now, the good news is it's also a very different opportunity profile, but your lender should always talk with you about both how does the debt facilitate the opportunity, but what are the obligations associated with it? And most buyers go through what I call an anxiety arc. So as they get into the process, they're excited and they're mostly, really thinking about the future and being a small business owner. As it becomes more real and they get closer to signing those papers that say, you now have a load of debt and some personal obligations associated with it, that anxiety arc increases over time. And making sure as a buyer that you are emotionally prepared as well as financially prepared is really key. There are a lot of good buyers in the market. There are a lot of financially qualified buyers in the market. There is a subset that will never buy. And it's okay if you look. The one thing I do advise is avoid getting deep into a transaction and pulling out. That can be very painful to all parties. But part of the process on the buy side is very important to think about emotionally. How will this change? What are the obligations that you and your family may deal with? And are you willing to take on those obligations related to the opportunity that you want to pursue? So the numbers are important, but the fit between the business and the buyer and the fit of just the risk profile of being a small business owner to me is really key.
If I could add to that, Joel, just for a second, to go on John's comment, it's really a culture issue. If you look at the history of deals that fail after closing, it's almost always, or at least in many parts, a question of a failed cultural match. They just did not fit well together. They may have looked like a good acquisition or a good merger on paper in the numbers, but they didn't fit. I mean, the classic example is when Daimler-Benz acquired Chrysler, which made a lot of sense on paper, but was an absolute disaster and cost Daimler-Benz billions of dollars. The cultures did not at all mesh. So when I talk to a seller or a buyer, and they're talking with the counterpart, say, look at how you fit together. Is there a good cultural match here in terms of style, of employee morale, of staff decision-making? Do they fit well together? That's a really important part of it.
That's a good point.
Right. So as part of the, from our perspective, when we work with the sellers and buyers, we do meetings, buyer-seller meetings, and really it's important to have the synergy and some sort of connection there too. With differently from buying a, say, real estate property for an investment, buying a business is that you get involved in the culture that was built by the current owner as a buyer. And from seller perspective, buyer is buying the culture, and there are asset component. We're talking about the tangible and intangible. There's tangible of the furniture, fiction, equipment, and there's inventory, and there's all sorts of things that come with the business. Intangible, which is customers, employees, infrastructure they built, maybe intellectual properties. It could be the some sort of trademarks, or the way that they perform the business, whether it's on the platform of e-commerce or storefront. There's so many different dynamics that come with it. It's important that buyer and seller actually has the good synergy as they work through, because at the end of the day, when going through a transition after the post-closing activities, there's going to be a lot of interactions as well. And some business owners, depends on the size of transaction and then how its deals is structured. Some business owners, sellers stay with the buyer to help them grow as part of either equity owner or consultant or the employees. So that based on how it's all done and put together, the length of the relationship goes even longer. So I agree with John to his comment. Emotional components is important. And also be prepared. It's kind of like a jumping off the cliff and hope to land in the other side of the cliff. But be sure to have that component ready. I think is very, very important. We see the same thing, and we ask the same questions. Are you ready? Are you really?
It's a leap of faith.
Leap of faith.
Yeah.
That's exactly what it is. It sure is. It sure is. Yeah. And I personally have gone through that process myself too, and it's rewarding, and there are other perks, and it's hard work. But at the same time, it's a decision an individual has to make. Lisa, I'm sorry I interrupted you.
No. But picking up on your comment about business owners, sellers staying on, I see we have a question about that and how that might, if a seller stays on for a period of time, how might that impact the sale, and does it impact taxes, things like that. It is not uncommon, particularly with financial buyers, private equity funds, investors who don't have the experience to have, who don't have the hands-on experience with that particular business to have the owner stay on for a while. But other cases too, when, so I see it across the board. In small companies, it's typically weeks to months. if a private equity company is the buyer and you own and want to keep some money on the table, they might want to keep you around for a significant period of time. Obviously, you'd have to be open to that. It doesn't prohibit a sale. It's not a requirement. I think buyers will work around it if you don't want to stay. And in terms of taxes, it can have an impact if you're allocating a portion of the purchase price to a non-compete or to a consulting arrangement. But working with an accountant and lawyer ahead of time, I think you're really going to be able to manage it in a way that makes sense from a tax perspective. So it isn't an impediment, and it isn't going to hurt you if you want to do that. I think coming to an understanding with the buyer early on about what they want and what your role would be and how you'd be compensated for that are really the key issues to think about versus the tax impact.
Staying on topic with about what the market is like too, we have a question here on whether that might change, and that's with a lot of boomers retiring and many of them selling soon, do you see a shift to a buyer's market with an increase in inventory in the coming years? Asking you to get out your crystal balls a little bit here, but do you see that shifting at all? And I'll throw that to whoever wants to answer too.
I can pick up on that a little bit. You know, it's kind of like almost our macroeconomic cycle. So let's kind of compare it to the maybe housing market. In the housing market, there's a seller's market and buyer's market. When does it become buyer's market versus seller's market based on the supply and demand? So to answer, there is no crystal ball, but if we think logically and using our sort of common sense, for the years to come, depends on what the supplies, how that looks. There might be a higher competition, but at the same time, based on financing world, John, maybe you can add this too, is if interest rate goes up, how does it impact the buyer's behaviors too? Also, valuation, much likely the valuation of business is going to make at sometimes hindrances or decisions to go forward. So for instance, back in the 2008 to 2011, after post 2011, the valuation was during that time was very low. So that makes a difference. Overall market decision-making activities is more of a macro, I think a trend is going to end up being. And usually, I mean, if we see historically, there's a macroeconomic change cycle sort of somewhere between 10 to 12 years. And maybe Don as a professor kind of teaching the economy and financial side, you can address it a little bit more too, but you know, changes to come to a certain degree, we just don't know what the degree of the difference is going to be. If we look at 2011 recovery from the, tough time and the recession we had back then, we're kind of hitting that the marks of the 10 to 12 years right now too. So I don't have I don't have a crystal ball. The other thing that's going to impact too is capital gains tax. I've had quite a few people talking about postulated tax that's coming in with the new administration, and how will that impact depends on size of the business again. If it's small business owners, might not as much. For the say a mid-market business, low mid-market or mid-market in the private market sector, at least that might make a big difference to them, because even right now we're talking about capital gains tax depends on how the purchase price allocation is done. Depends on what that looks like. It might vary, but say if capital gains tax rate is 20%, and then you add the state tax to that, and then you add the surcharge to that, and becomes like what right now 30%. It's going to go up next year for the owners with a million plus. So that's true. It's going to be almost 40 to 50% based on what the state tax is going to be. So these are things to consider and keep in mind as far as what's going to be the trend. And I think there are so many external factors. So we say the business value, a lot of times think about it this way. There is earnings, it's the earning divided by risks. There's internal risks you can manage, there's external risks you can't manage, or you can't control. So
Okay.
those are really important factors to keep in mind as business owners, because I can say, you know what, my business is going well, I'm going to stick around, but could the valuation change? Absolutely, yes. Because historically it's shown that numbers kind of fluctuate just like along with the macroeconomy. Go ahead, I'm sorry, John.
Oh, it's all right. I was just going to say, I've got a couple thoughts on the topic from the buy side. A couple things to think about. We do have historically low rates, and both economically and demographically, I would anticipate that those will continue for the foreseeable future. So that, of course, drives incentive to invest, because investing in capital is cheaper. The other thing that's going on in the background is lots and lots of stimulus. So the stimulus is absolutely going to affect the economy. Now it creates other risks, of course, but stimulus has stimulated. So, and again, I think the stimulus will have quite a long tail and keep the markets elevated. The other issue I want to talk about is quality. As most of us here know, there are a lot of businesses for sale that may not be of wonderful quality. And most of my buyers want to find quality. There is certainly a movement to quality in the market. The pandemic and its impact on companies will accentuate that. So to me, a big part of the driver is the number of qualified buyers has stayed high. The number of quality sellers is going down. It was already not enough to meet demand pre-pandemic. Post-pandemic, there are even fewer quality listings. So the number of qualified buyers chasing those high quality listings that have persevered and survived well through the pandemic, from my point of view, says we're going to have a pretty strong seller's market into the foreseeable future, unless there's somewhat of a prolonged recession post-pandemic. But at this point, we're just not seeing that.
There's another demographic question, so I'll throw it in right now too. Do you see Gen Z wanting to acquire businesses too? They're starting their own businesses at record rates, but are they buying? And how do they get qualified to buy if they're not buying? Do you have any follow-up on that for the younger generation?
As one of the older ones in the room, I'll answer that. So far, I'm Gen A or B or something. I don't know what letter I'm at. What I'm seeing from the Gen Zs, though, is that they're starting software businesses, which require very, very little capital to raise. Basically, it's two computers and a programmer, and they can raise almost. It requires very little money to raise to start a Gen Z business. They're not buying the capital-intensive businesses like manufacturing or retail, because they aren't thinking in terms of retail. So I don't see a lot of Gen Zs buying businesses. I see them starting businesses. I do a lot of mentoring at the U of M, and I talk with these Gen Z entrepreneurs, and they're wonderful. They're challenging to work with, but they don't want to buy something. They want to start something.
That's a good point.
And Joel, I certainly I do want folks to know that bankers are known for saying no. If you are a young entrepreneur and you want to be a business owner, there are two primary ways to do it: start one of your own or buy somebody else's. And to me, buying somebody else's actually does make a lot of sense. You already have a customer base. You already have hopefully employees. You may have a product or a set of products. And the one thing that many young people have that older folks don't is they can live very cheaply, because they don't necessarily have dependents. They don't have other expenses that tend to come with age and other obligations and children and college, et cetera. So one of the things a lender like myself looks for is what is the household cost and what is the burden on the new business. When a broker analyzes a business for sale, they're generally looking at EBITDA or adjusted EBITDA or seller's discretionary earnings. Mm-hmm. From that, somebody like me has to take out some appropriate pay for the owner, plus cash flow to service debt and to support value. Some buyers can live on very little, which puts a little burden on the business. Some buyers need significantly more to serve their lifestyle. So I will say that's the real advantage that younger folks tend to have, is they can live more cheaply, and somebody who can live more cheaply can more easily finance a business. Often their bigger challenge is their capital injection, their down payment, so to speak, into the purchase. and that's where I go friends, family, investors. Certainly there is capital out there. But I typically do at least one, if not multiple transactions a year with an entrepreneur that's in their 20s. And to me, I would consider that fairly low to be getting funded with debt, fairly young age to be getting funded with debt in the marketplace. Credible education, credible experience, can live fairly cheaply. They understand the business. If they can come up with that capital, they're very viable buyers.
Mhm.
The other thing, Joel, real quick,
Yeah.
I think is the multi-generational component of that.
Yes.
You see a lot of an older business owner passing on to the next generation. That next generation is going to run that business differently, probably more in tune with marketing and running businesses today. So absolutely, I'm seeing a number of folks in the next generation taking over business and expanding that business, maybe in a similar area or vertical integration. But so I definitely, I think that there's an opportunity also for that next generation to look at expanding an old family business in a new way.
Mhm.
Maybe build on that a little bit. There have been some questions about generational transactions. Can you talk a little bit, Brian, maybe about financial plans, family plans, any special considerations when you're doing that, when you're handing off a business to a different generation, maybe? Are there any special concerns? We'll just start with Brian, but anybody can jump into there.
I'll just touch on it briefly. The federal estate tax is 40% for amounts over 11.7 million. As a couple, it's 23.4. But I'm going to guess almost everyone on this call is in the state of Minnesota. And so federal doesn't really become much of an issue because for 2021, that estate tax exemption is 3 million. By the way, Minnesota state tax is about 16% max rate right now. So a married couple can shelter about $6 million in the state of Minnesota from estate taxes. So those federal numbers are, really get rid of a lot of mere mortals, but $6 million in the state of Minnesota, that's a lot of folks, especially if they're looking at selling a business. So certainly focusing on how do we efficiently pass wealth or business to the next generation is important. The real tough thing, Joel, is it's not a one size fits all thing. It's actually normally very customized, and so not necessarily a one size fits all solution. I guess maybe Lisa can touch on that a little more.
Happy to. I think, and one of the questions that I saw come up was, a sale of a service business, for example, and valuing that. And just thinking about that, it's very difficult for somebody who runs their business based on the value of services they provide, say, for me as an attorney, to try and sell it to someone else. Because the reputation, the relationships, the work I bring in comes from me. And so the value relates to me and my being there. And that goes for a lot of service businesses. It can be difficult to transition them. So that's one of the things you have to think about when you're planning this transition, getting people involved early, in a family business. Do you want other family members to be involved early on, to build up that expertise, to build up those relationships, to be in the right position to take on running the business? From an estate planning perspective, I know there's strategies you can employ, although I will say that's not my area, in how to shelter your business from Minnesota taxes. But usually the more time you have, the better. So if you can do this while your family members are involved in the business over a period of years and the number of years, and take advantage of the dips in the value of the business to transfer when the value is lower, you're really going to come out ahead. And so it is something you want to have in your mind for the long term.
Thank you, Lisa. I want to quickly change topics to, I'm going to combine a few questions here all in one, but I wonder, talk about maybe just getting help in this process and professional services companies, either if you're a buyer or a seller. Maybe we can start with you, Don or Young.
Sure.
How do you find the right broker to work with to sell your company? And then maybe for the rest of the panel to be thinking about too, what other help is out there for even buyers, like
Sure.
they can get for this too. So if you wanted to start, just finding
Sure,
that
I'd be happy
right
to.
broker.
I would start by talking to your colleagues who recently bought or sold a company. Say, who did you work with and what was your experience like? The other thing is most of them have an attorney and a CPA already, and ask them for a referral to who may have worked with in the past. But I would point out, to me, the importance of using a broker, because the broker does a couple of things that nobody else really can do. One of them is to serve as that kind of a quarterback to bring in the specialized talent. If you look at this panel here, for example, every company has an attorney. That attorney doesn't have the specialized knowledge of M&A that someone like Lisa has. And every business owner probably has a broker to handle his investments, but not a specialized broker like a Brian, who can handle the wealth management of a business sale and an exit. So we act as kind of a quarterback. We bring in the Lisa and the Brian and the John to make a specialized team. That's one thing. The other thing I would encourage anybody who's looking for a broker is just to sit down and meet with them, just talk with them. A lot of it has to do with just personal vibe. If you feel comfortable with that person, if you like them, if you have confidence in them, that goes a long way. Or you might meet with them and say, well, I don't really feel that comfortable with them, and I'll go on and look at somebody else. And the other point I would make is ask them about their database. This is, to me, a really important point, that Young and I can provide a national database of buyers, sellers, and investors. So we can plug a seller or a buyer through a targeted campaign into this large database, a national database of potential buyers. So for example, the client that we have right now is a local company that's selling their business, and the buyer that we are working with now, we have a signed LOI, is out in the Western states. And how would you find them unless you have a broker who has that kind of a database to sift through and to find a potential buyer? So that's a plug for Young and I would say.
Yeah.
Okay.
And well said, Don. If I may add a little bit there too, sometimes I kind of think, like, from my healthcare operation background, I say this, in healthcare term, we have something called ISP, right? It's individualized service plan. And that sort of strategizes where to go from there. And I say that in the sense, what I see from marketplace, working with the owners, business owners or buyers, every single one of them are in a different point of their journey, and not all one strategy fits all. So and then I go back to then, who's my primary doctor versus specialists, right? So primary doctor could be actually Brian, it could be John, it could be Lisa, it could be us, or some. And so then really kind of the dynamic changes a little bit, depends on who we work with and what point of journey they're in. So I would say good collaborators, kind of like a care coordination. Not that I'm saying that everybody's patients, right? But I'm using that analogy to kind of make a sense for, every business is a little bit different based on the stage and size, target, and why they are thinking about buying or selling. And then what's the strategy from there? And I think it's important to have that strategy, and potentially, the business owner, as an owner, it's hard to run day-to-day businesses. And how do you coordinate all of that yourself, really? So have an advisor that you work with to be able to help coordinate and triage that. And our process from brokerage standpoint is we look at a whole spectrum of the process. If there is an ISP, individualized service plan, for an example, which is a sales strategy, where do we go from there as marketing to a finding buyers and the buyer management, to the due diligence, to the closing, and then what's after that? So it's really a whole life cycle is important process to think through, but it's hard to do it on as one person. Even if I look at, say, as a business owner, do I look to somebody else to get some help collaboratively so that things can work out in a seamless process, and anticipate what might come up as a challenge or trouble in advance based on what the circumstances. And those are anticipatory items are also very important. So going through a disciplined process with the right advisors, I think it's very important.
Great comment. I'm going to switch topics again. I'm going to combine a bunch of questions all into one. So it seems like, and John, maybe I'll start with you on this too. You've mentioned too that maybe the old rules don't apply now with what we've been through, the recession, COVID and such too. 2020 and 2021 financials will have a lot of noise on them. And there's a lot of questions about valuation. From both a selling and buying perspective, I'll start with you, John. Can a lender help with this understanding of evaluation or the structuring of an offer? Do you have some points or thoughts to begin our talk about? How do you value companies, or what's in this environment that we're in?
Sure, I'll give you my point of view. I have an opinion on almost everything, sometimes it's right. So my point of view would be that the lender, yes, absolutely has to have an opinion on that topic. The key thing I like buyers to know is it's a lender's opinion. In other words, it's not an entrepreneur's opinion. It's not a specific buyer's opinion. It's a lender's opinion. And a lender's opinion is contextual to the funding of debt. Is it bank debt? Is it SBA debt? Those have particular points of view. So I often end up in a situation where I tell someone, hey, this might be a good business opportunity, but it's not a good lending opportunity. But within my spectrum of funding, I absolutely have opinions related to value and what might be supportable value and what might make sense for the buyer. For me personally, there's no worse feeling than helping somebody into a bad situation. So I seek to avoid that. So understanding the dynamics, understanding the person and their personal needs, understanding just in terms of sheer probability, do we have a lot of things that say this is a high probability good outcome? The other way I tend to phrase it is we absolutely want the seller to get a great harvest. We want the buyer to get a fertile field for the next harvest. So I can help folks do that through my own lens. But again, I go, I am not a certified business appraiser. Young is. I am not a broker. Don and Young are. So my expertise is around value related to funding via a particular vehicle. Again, that being said, that's the vehicle my clients are likely to use. So it's the most relevant point of view. And my opinion is also linked to the funding source, and that gives the opinion some value. When the opinion comes with money, it's more important than opinions that don't come with money. So I think that's kind of a key part of it. Just to touch on 2020 and 2021, there are things happening in the market. Lisa mentioned PPP loans. If a business had a PPP loan that was forgiven in 2020, those dollars are likely to show up in revenue as other income. When debt is forgiven, it shows up as income. As a buyer and as a lender, you need to know how to treat that. What do you think about that? How should we treat it? So there is a lot of noise in 2020 financials. There will be some in 2021 financials. Things like PPP loans, EIDL loans, grants. There was a lot of stimulus in the marketplace depending on the type of business that you have. So my advice to folks is expect due diligence to be a little more thorough now, a little bit more thoughtful. But that being said, it's not rocket science. These are things we know and understand. The key is how did they impact in this particular context?
Okay. Anybody else? Yep, go ahead.
Yeah, if I may, as far as valuation wise, I think with what's happening in 2020, I think I see the change in the tone of how to treat this. So in the beginning, really assumption was this was going to last for a very short amount of time. So do a, add back potentially, whether it is a adjustment, financial adjustment, positively or negatively. If it's one-time income like PPP or whatever, usually we do make an adjustment for those anyhow. But to make an adjustment for what had happened short amount of time. But now this has been going on for a while since the pandemic started in March. So really kind of looking at to John's point, it's really important to understand that the lender has to approve. So what we see it as normalized operation as a valuation might not necessarily be a financeable. So it's important for buyers and sellers to understand and it goes back to the right sort of expectations if they want to sell and the business has declined. I recently had a meeting with a potential buyer who was in the space of wanting to do a management buyout. So internal transaction it would have been. The problem was that it would be very difficult to finance through the bank, although business was very attractive and strong. So in a year ago, potentially the valuation would have been somewhere probably $700,000 to $900,000. Haven't looked at all the books in detail, but with the pandemic, it really changed the shape of the business completely. So this is one of the, I think, most impacted business that we kind of looked at. I would say really what makes sense for the buyer and the seller.
Can I chirp in real quick? And as humans, we tend to look and make emotional decisions on what's right on our face. But I will tell you this, that as the calendar flipped, our economists were anticipating economic growth in the United States to be right around 6%. Less than a week and a half ago, they upgraded that to over 7% for the coming year. And so I do think that and much of the malaise of 2021 is going to be in the first quarter. And so I do think that you're going to start to see, as the vaccines are rolled out and economic and consumer attitudes improve, that economic activity will also be significantly better when we get to the end of the year.
Right. I think that's a good projection too, Brian. And then to that point, really based on what makes sense, if they're, talking about the buying and selling perspective is really maybe right now start the conversation and have a transaction in place that's going to have some sort of feature rewards for the seller stronger, and then so the buyer can come into a transaction with a seller if they're not necessarily financeable, and then refinance that deal working through the bank when business turns around too. So there are ways to structure those, working with the, Lisa, maybe you can add to that too. If there's the structure that makes sense for the buyer and seller to going in and then put something in place with the risks involved in mind. And again, it goes back to how much the two parties want to go into transaction and kind of looking at the risks and reward and things like that. So anything you want to add, Lisa, from your perspective? Have you seen those circumstances coming up where, geez, I kind of want to have this done and I know this is in my best interest, want to get done, but how do we get this done?
Well, certainly there have been a number of transactions where sellers are really motivated during this last year, just wanting a transaction. I think where we do have like the noise in the financials, as John was saying, and the stop and starts of the last year, we're seeing a lot of earnouts, and those can be a great way to bridge the gap in valuation. They come with a lot of issues. You've got to come up with the target. Is it top line? Is it something that takes in profitability into account? Is it short-term, months to a year? Is it multiple years? If it's multiple years, are there multiple payments? What happens if you make the second one, you miss the first one, but make the second? Do you catch up? What happens if vice versa? How's the business going to be run? What kind of, are there any limitations on what the buyer can do? Will the company have the resources to meet these targets? Adequate sales personnel, adequate capital for equipment, things like that. So earnouts are a great way to bridge that valuation gap. There's a lot of issues to document.
We're coming to a close, but I want to ask each of you one quick question to kind of bring in everything we talked about, if we can quickly. Whether it's in that beginning phase, you're preparing for the sale, or if you're in the middle of the sale, or even talking about after it and closing and handling proceeds from the sale, whatever it is. So I'd like to ask each of you, based on your perspective, we'll start with you, Don, but what's one thing you would recommend and what's one thing you would avoid, if you're just giving, or just to kind of encapsulate your thinking just from your perspective too. And I'll ask each of you that same question.
As a seller or as a buyer, or either one?
Either way, whatever comes to your mind, even. I know you work with sellers, but
Well, no, I'll do both. We work with a lot of buyers too. In fact, my last transaction with John was a buyer.
okay.
We bought a chemical manufacturing company here in town. I would say, first of all, be patient. Do your work very, very carefully. As an aside point, I do a lot of expert witness testifying in financial litigation. And in the vast majority of those cases, it's because the legal work was done poorly 4 years ago, 5 years ago. Now it comes back to haunt them. And they did not do the documents properly. They did not do the due diligence properly. They raced through the transaction and they left behind little landmines all along the way. And now they explode 5 years later. So be patient and do your work really carefully. Hire a good lawyer, a good fund manager, a good banker, a good broker, obviously, and do the work very, very carefully, because you're talking about a great deal of money, a great deal of liability and risk that can come back to haunt you at a future point. So be careful and be patient.
Young, do you want to answer that next?
Oh, sure. Yeah. Recommendations. I think whether business is doing well now, not a lot of worries, or business is struggling, I think always think ahead. Think ahead, and we love having conversations early on, 2 to 3 years prior to it, to talk about what are some of the business benchmarks and metrics that are important to as business grows or stabilizes or whichever ways. So have early conversation with your advisors, and what to avoid. I would say for me, always stay humble in the process, because we have, through the negotiation phase, things can be challenging, but that's the time. I see that as negotiating time is really a time to build a relationship too. And it's a small world. It gets smaller and smaller sometimes. So, the people that you interact with and advisors, brokers, we all kind of end up in the same world. So I think that through no matter what, and that's more of a dynamic, I think, and that could be a sellers too. I could be a buyer approaching sellers directly and saying, I want to buy your business. Or a seller could be approaching the other party and say, I want to sell my business to you. In all shape or form, I think just kind of staying humble throughout the process is important. So it's not necessarily avoid, but I think there's been a time where, sometimes things are a little bit more aggressive, and it has to be really beneficial for the sellers and buyers, and through the process too. So having a good synergy along the process, to me, I think is important.
Thank you. John, quickly, do you have one thing to recommend, one thing to avoid? What comes to your mind?
So my advice would be get to know a lender. If you're interested in being in the market, get to know a lender, get pre-qualified, be active, don't be shy, sign NDAs, get packages. The more you look, the better you get at looking. My thing to avoid is non or bad marital communication. If you're a married person, having your spouse on board and other family members on board, but most importantly, your spouse. The single biggest thing that drives late anxiety in my transactions is differing expectations between spouses, when one spouse is actively involved in the purchase and the other one isn't. And those things tend to bubble up a little late in the game. So open, often, and early marital communication is my, avoid not doing that.
Very good point.
Great advice always. I know we're running a little long, but Lisa, do you have quickly one thing to recommend, one thing to avoid?
Well, I'd say have realistic expectations about the time frame. Your LOI might have 45 to 90 days, but in my experience, deals typically go beyond that time frame stated in the LOI. The thing to avoid, I'd say, is don't put off making decisions about your business and how to run it, thinking that your buyer is going to want to do stuff if you need to invest in capital expenditures, if you need to bring on new employees, if you need to terminate employees, do all that stuff. Don't think the next person's going to do it. I just also want to add, I think there were a couple questions we didn't answer on like EBITDA multipliers versus valuing cash, equipment, and assets. And I'm not sure I addressed the sellers or the question about valuing the service business. And so I'd be happy for those participants to reach out to me with the contact info that got posted and talk to them or respond to questions.
That's great. Appreciate that. Brian, what are your thoughts as we wrap up here? One thing to recommend. What do you want to avoid?
I guess the first thing I would say would be trust. You are seeking professionals that you trust. And how do you do that? Well, if you already are working with young, you would say, hey, young, do you have somebody in this area, whether it be a banker or a wealth manager that you trust? Or if you're a business owner and you talk to other business owners, ask them, who do you know that you trust, that you recommend, that you have experience? So my number one recommendation was seek out professionals that you trust. And then what would I avoid? I would avoid working, in my area, focusing on price and performance immediately. For me, is not necessarily that's something I would avoid. And I would say, what are you looking at for advice? Do you want to take advice? Are you looking for a professional who will guide you through this whole process? The price and the performance will absolutely come and be attractive if you're working with a professional that knows what they're doing and fair to all concerned.
Thank you. I know we're running a bit long, but I really appreciate it. Thank you everyone for attending today. Again, this will be made available as a video later on and also as an episode on our podcast, Beyond the Skyline. Thank you, panelists. We could talk all day on this subject. I know there are 1,000
Thanks,
things.
Joel.
Thank you, Joel.
Appreciate
Thanks,
it.
everybody.
Yeah. Thanks, everybody.
Thanks,
Take care,
everybody.
guys. Thank you. Pleasure to work with you.